All right, this is a recording for Chapter 3. You're going to be looking at the income statement, and so you need to make sure that you've read the chapter and studied the material. I'm just going to touch on some high points here as I kind of walk through this for you. Again, this is not supposed to be an exhaustive lecture, but more of a discussion of some of the high points. There's a lot of detail buried within the chapter. These are short chapters, but that means that they're kind of packed full of information that you need to be able to pull out. And again, I suggest that you use the slides, print them out as notes, and then write extra notes on them as you go through reading the chapter and trying to pull out of it everything that you possibly need. So we have two basic formats for the income statement. There's a single step and the multiple step. And the single step just means that we're going to calculate net income in one step. Whereas with multiple step, it means we're going to calculate net income in multiple incremental steps. And we'll see what we mean here. You'll see what I mean when we take a look at the examples from the book here. So first, this is a single step income statement. Notice that up in the top portion, you've got income, net sales, and interest income. In this particular example, those are the only forms of income this company had. And so they gathered them together up at the top and total all of the income. And then all the costs and expenses, your cost of goods sold, the interest expense, income taxes, and all the operating expenses are all collected and aggregated in the lower portion of the statement, and they're summed together. And so that the net earnings is your income minus expenses. So the single step really follows along with the formula, revenue minus expenses equals net income. It very closely follows that formula. However, from an analyst perspective or from an investor's perspective, it isn't quite as useful. The other thing to notice is at the bottom, after net earnings, the Securities and Exchange Commission and GAAP like to have the earnings per share information reported, and so they report both a basic and a diluted earnings per share. And I don't know if you guys recall or not, but diluted earnings per share versus basic is diluted means that there are certain types of transactions which could increase the number of shares outstanding. And because it's possible to increase the number of shares outstanding through these actions, then they have to report what the effect of those transactions could be on earnings per share. And so if you look at 2016, you'll see that basic earnings per common share is $2.16 per share. So it's the total number of shares actually outstanding divided into the net earnings. Okay. Under diluted earnings per share, there are some other transactions, like maybe some options that management holds that they can purchase shares at some discounted price. If they were to execute those, it would increase the number of shares outstanding, and the earnings per share would go from $2.16 down to $2.12. So it's a piece of information that investors and analysts like to know. So that's worthwhile to know. So this is an example of the single step statement. It's very simple, very basic. When we want to know a little bit more information, when we want to break things out a little bit more, we can reorganize this into multiple steps and have some intermediate steps. And so this is what a multiple step would typically look like. Here we've taken our net sales and we're going to net it against cost of goods sold to come up with an amount called gross profit. So gross profit is just your net sales minus the cost of goods sold. We do not include the operating expenses in there. This is just the cost associated with whatever product it is you sold. All right, this next comes all of the different operating expenses, your selling and administration, your advertising, your depreciation and amortization, and in this case they had some impairment charges, which means that they've written down some asset of some type. Could be capital assets, it could be intangibles. All of that gets thrown into the mix and becomes expenses after gross profit. So you would take your gross profit amount minus all those operating expenses to calculate operating profit. Now, after that, there are some other things that can kind of pop in. So you're going to have other items of income and expense. So in this case, we're going to segregate out our interest income and our interest expense. And those are the only two items that they have. And so they have earnings before income taxes. And that amount is just the operating profit minus or plus the net effect of that other income or expense. And so then we're going to calculate our net earnings, but our net earnings has to be, we want to know what that is after taxes. So we first have our earnings before income taxes. Some people may call that something else. Typically, you're going to see it as EBIT, earnings before income taxes. And then your provision for income taxes, there's usually going to be some kind of a rate that they're going to associate with this. It might be 40%, it might be 35%, it just depends. And so they multiply the earnings before taxes against that rate. That gives you your provision for income taxes, and then you calculate your net earnings. From there, you can go ahead from the balance sheet. You can pull the number of shares outstanding. You have to calculate the number of diluted shares. They'll do that in the accounting department, and then they'll calculate those two numbers for you, the basic and the diluted. And here they've given you at the bottom, they've told you, okay, so the weighted average common shares outstanding, they give you the basic and the diluted numbers. Again, those are going to come from the financial reporting section under the controller. So the multiple step as opposed to the single step income statement gives us a gross profit, an operating profit, an earning before income taxes, and a net earnings figure. So instead of just having one number, net income, we now have 4 different steps. And so that means that we can do a lot more analysis on a company's earnings, determining if net income changed from one year to the next, which it did from 2015 to 2016, look at the change in net earnings. So in a single step statement, it's not quite as clear why it changed. We can see the change more vividly when we look at a multiple step income statement and see, okay, what drove the change here? And so we can see right off the bat that gross profit increased. From 2014 to 2015, there was an increase, but there was a bigger increase between 2015 and 2016. And so you can calculate the change in the net earnings and then go back and look at what drove that change. Another way that you could do this is by looking at it in terms of being a common size income statement. And so next, we're going to take a look at a common size income statement. And so again, in a common size income statement, just like in a common size balance sheet, everything is going to be measured against net sales. So net sales ends up being 100%. And so you want to know what everything else is relative to net sales. So again, focusing on the 2016 column, we notice the cost of goods sold is 60% of net sales. That's what that means. So that means if net sales is 100% and cost of goods sold is 60% of that, gross profit has to be 40%. All right, then you get down to operating expenses, and these are each percentages of net sales. And so you can look across the years from 2012 through 2016, and you can look to see whether the relationships have changed. So this is relative. These are relative numbers. So everything is relative to 100% net sales. It kind of puts everything on an even plane because, each year net sales was different. I'm sorry. Net sales was different for each year, but when we common size it, it actually puts all of the years on an even footing. Net sales becomes 100%. And so we can look to see what's changed. So in this case, what we've seen is that from 2012 to 2016, the cost of goods sold has moved from 58.2% of net sales to 60% of net sales. That's not a huge increase. But again, you want to know what it is. Same thing with all the other expenses. You want to know if anything has radically changed. So in the case with operating profit as a percentage of net sales has dropped from 11.6% to 8.9%. So something has gone up. And so the things that have gone up is you've had some increase in the cost of goods sold, and you've had some increase in some of the operating expenses. And so you had your selling and administration expenses went from 20% to 21.2%. So they've gone up a little bit. And so what's happened here is any decreases in some operating expenses have been offset by increases in others, and have been impacted by the increase in the cost of goods sold. Then at the bottom you can see your interest income and interest expense as a percentage, and then your earnings before income taxes. Now again, notice in 2012 it started out at 10.9% of net sales. So that's like saying for every dollar of net sales you have, you are getting earnings before income taxes, you're getting almost 11 cents out of that dollar. By 2016, you're only getting 7.9 cents per dollar out of it for earnings before taxes. And again, the provision for income taxes is going to follow that, because income taxes follow the amount of net income or earnings before income taxes. And then your net earnings is the net, and it's dropped from 5.2% to 4.3%. So this is one way to kind of break down and analyze an income statement. It does it in relative terms rather than absolute or real dollar terms, because again, it equalizes net sales across the years when we know that the actual net sales were different for each year, but in each year net sales was 100%. So I hope you guys understand that. If you don't, you can always email me with some questions. Now there's some other things to consider in analyzing individual items. So first we can take a look at the math. And by the math, what I'm going to mean here is we want to be able to take a look at this top portion where we say net sales, cost of goods sold, and gross profit. Because sometimes questions come up, and I've seen this because it happened last semester, where somebody was given some information about those three items and then asked to calculate something. And this class really struggled with that, and this is why. Okay, so we have here an example where we have cost of goods sold versus sales and gross profit. So sales are $10, cost of goods sold $4. We calculate gross profit at $6. And so in year one, 100% is the $10. So that means the $4 compared to the sales of $10, that's 40%. And gross profit has to be 60%. A lot of times what they'll do is they'll tell you that maybe they'll give you the sales figure and the gross profit. They won't tell you what the cost of goods sold is, and they'll ask you to figure that out. They can give you different combinations of these numbers, and this is what you have to remember, the format you need to put it in. And then you're basically solving for whatever the missing piece of information is. And so again, so you can look at it and say, again, notice year two says $8, but it's 100%. So that's the relative effect. When you turn it into a percentage, both year one and year two, sales is 100%. But yet in year one, it was $10. In year two, it was $8. So you can look at it both in terms of, well, sales decreased from $8 to $10, but it was still 100% for that year. But what you can determine here is that, yes, look at cost of goods sold. Cost of goods sold didn't change. So something happened to the sales. You either sold less or you sold it for less. So you either had a volume drop or you had a pricing drop. And there's ways that you can go in and kind of dissect it to figure out what the cause happened to be. Okay? So at any rate, that's the math behind playing around with sales, cost of goods sold, and gross profit. And this is kind of an important area because, I mean, this is the first step. And so if you don't take a good first step, this is going to affect every step you take after it. And so that's why there tends to be a lot of focus on this gross profit calculation. We have some other things that we can take a look at. There's a lot of relationships that exist within the income statement. And so the first one is just your gross profit margin, what they call gross profit margin, which is that percentage that I told you about. And you just take the gross profit amount in dollars and divide it by the net sales in dollars, and that comes up with your percentage. So then you can go ahead and calculate each year what that gross profit percentage happens to be. So you know net sales is 100%, and you know in this case the gross profit is 40%. So then what's cost of goods sold? Cost of goods sold is 60%. And you can also calculate what the dollar amount is, because if you take the difference between net sales and gross profit, that is the cost of goods sold. So even though they didn't directly give it to you, they gave it to you indirectly. That's what you have to remember about some accounting problems. Even on tests and as you move forward in real life, you may be missing a piece of information, but if you remember the relationships that exist within the financial statements, many times you can figure out what the missing amount is without going through a whole search of the system for the information. You can actually calculate it based on the information that you do have. So I always suggest try the easy route first and try to back into the number that's missing. If that doesn't work, then you're going to have to go through all the work of trying to figure out what it is by backtracking through the numbers. So that is your gross profit margin. Another thing you're going to look at is various operating expenses as a percentage of net sales. Advertising is really important. People don't realize it, or maybe they don't realize it. I noticed in some classes some of the students pick up on this and others don't, but advertising is a marketing expense, and we advertise so that we can try to reach our customers or potential customers to let them know about our products and services to try to increase sales. And so if you were to suddenly stop spending on advertising, that could be an indication of a shift in strategy. It could be a negative sign, it could be a positive sign. It all depends on the circumstances. And so that's that background research, that reading that you do about the company, reading the MD&A, reading the notes, reading what the market is having to say. If you see a drop in the advertising spending of a company, you need to be looking at it as, is this going to impact net sales in the long term? Okay, that's an important question. So you can be looking at advertising as a percentage of net sales. You can also look at depreciation and amortization against the items that are being depreciated and amortized. Okay, that percentage shouldn't change a lot from year to year. It will change some because as you add and subtract different capital assets, so if you're retiring or selling some assets and then you're buying some new ones, the depreciation and amortization relationship to the asset base itself may fluctuate, but it shouldn't fluctuate a lot. That relationship should be fairly stable. So the change from 2015 to 2016, going from 11.6% to 10%, we did see an increase in the amount of assets. And so that means they've added more assets to the mix. Now, they could have taken some assets off, okay, and replace them with newer assets. And maybe those assets weren't placed into service at the beginning of the year. And so if they placed them into service later in the year, it means they wouldn't have taken as much depreciation on them, which could cause that relationship to drop. But when you're doing a financial statement analysis, that's what you want to focus on. The 11.6% and the 10%, that anybody can calculate. What people want to know is that 1.6% difference, what may have caused that? That's what they want to know. Cause and effect. That's what you're looking for. You see something, you notice a change, explain the change. But it has to be plausible. It has to be based on the objective information that you're looking at. You can't just guess. You've got to look at what the information is telling you. What is it saying to you? And then kind of pull that out and see, okay, read it out loud to yourself. Does this make sense? You know, in this case, the increase in the base, okay, would indicate again that they purchased additional assets. Those assets may have been placed in service later in the year. Do we know that for sure? No, we don't. But it is a plausible explanation that goes along with the increase in the balance. And so therefore the depreciation and amortization percentage would go down. Okay? Hopefully you guys follow that. The next example, repairs and maintenance. Like advertising, okay, advertising goes into directly affecting sales. So it's an operating expense that needs to be controlled and monitored, but if you just start cutting it, it could have a negative effect on later sales. Repairs and maintenance, the same thing. If all of a sudden you notice a drop in the repairs and maintenance cost, well, that could be a problem. Is it always a problem? Well, no. Look at this case. We just got finished talking about depreciation and amortization. Here we take a look at repairs and maintenance. Again, the base went up. So buildings, leasehold improvements, and equipment. We don't know from this information exactly what occurred. But if we were to go to the balance sheet, we'd be able to see which items went up. Well, if you've got newer equipment, it probably requires less repairs. And there probably is less maintenance because it may be under warranty. And so therefore the drop from 8.5% to 7.4% is explainable because there was an increase in the base, which means that they probably purchased newer equipment requiring less repairs and maintenance, and that more of the maintenance and repairs may have been done under some kind of warranty or service agreement. Okay? So simple enough. Operating profit margin. So once you get below all the operating expenses, you now hit that other calculation. And so you're calculating your operating profit. So that's gross profit minus your operating expenses. And so we look at it again as a percentage of net sales. Everything ends up being tied back to net sales. So again, at 8.9% in 2016, what does that mean? That means that, essentially for every dollar of net sales, you still got 8.9 cents, right? 8.9 cents remaining out of that dollar. Okay? It doesn't sound like a lot, but when you consider that there were $215,600 of sales revenue, you'd have to multiply that out. So, and then you end up with that 19,243 figure. And that looks more impressive. But when you're comparing across years or when you're comparing across companies and they're going to have different sale amounts, different volume numbers, different price numbers, it's important to be able to boil it down to these percentages to see, well, how do they do relative to their competitors, relative to the rest of the business segment they operate in. So this is an important feature, important set of calculations to consider. The effective tax rate, what does that mean? Well, we want to know what the effective tax rate is, so we calculate what our income taxes were relative to our earnings before those income taxes. And so again, that tells us what bite the government is taking from it. Now, income taxes is kind of a difficult area where I guess it's an emotional area to talk about. A lot of people kind of resent paying money to the government. I'm of a different mindset. Again, the government requires money to operate. Whether you agree or disagree with what they're spending it on is immaterial or is not really relevant to me. You do have to pay taxes, and the government needs to be funded to run, and it has to do so. And so again, you almost have to kind of take the emotional element out of it and just look at it as this is the way it is. We've got to pay taxes. It's necessary. It's a good thing that we pay taxes because it means that hopefully we have a healthy government that has the resources needed to do things like keep our military going, helping those that are in need, taking care of the elderly, doing all the things that we have placed on the government or placed that burden on the government to take care of, that they need the resources to do that. Okay? And so again, you have to separate out kind of the policy questions and the emotional portion of this and just focus on the calculation itself. And so again, for our earnings before taxes is 45% of our earnings before income taxes. That's what that means. Okay? And there's a little nuance about this in an earlier chapter. You learned about the difference between the income tax expense on the income statement and income taxes payable on the balance sheet. The income taxes payable on the balance sheet is the actual amount that's owed to the IRS. That's the amount, and this is simplified. I'm not dealing with state and local taxes. I'm only dealing with income taxes to the Internal Revenue Service. And so once they actually fill out their return, they're going to calculate what they actually owe the IRS. That becomes a payable. The amount of income tax expense that's recorded on the income statement is not the real number. That's an accrual number. Remember, we use accrual accounting to calculate our net income. And so when we calculate the taxes on that accrual-based net income, it's not what we're actually going to owe the IRS. Okay, it's a number that's based on the accrual amount of income. And so the difference between the net income, the taxes reported on the income statement versus the taxes payable reported on the balance sheet is either going to be a deferred tax asset or a deferred tax liability. Because the thing is with accrual accounting, I don't know if you remember me saying this or not, but what happens with accrual accounting is that it's different than cash accounting. Cash accounting, we look at cash receipts and cash disbursements. In accrual accounting, we don't look at the exchange of cash. We look at certain activities or actions having taken place. Transfer of title, completion of a sale, however they want to define it. And it has changed over time. And so we have a new current revenue recognition principle that's out there that kind of lays out, how do you recognize revenue? When do you know revenue is revenue? But once that occurs, and you're going to owe taxes on it, the accrual amount is kind of a fictitious amount in terms of what you're calculating. It's not, in the short term, it's not the real amount. In the long term, cash and net income tend to move together. So in the long term, if you say 50 years, over 50 years, if you were to look at the amount of cash coming in and coming out and looking at the difference in the cash flow relative to what's left of net income over time, so what's in retained earnings, those numbers should begin to move closer and closer together over time. So that's the theory behind it. And so what they do is they take the net income, calculate the taxes on the earnings before income taxes. So they come up with their income tax expense. That's the accrual-based number, and compare it to the income tax payable number, which comes off the tax return, and they calculate that difference, which becomes either a deferred tax asset or a deferred tax liability. The difference between an asset and a liability is whether you're going to owe taxes in the future or whether you're going to get some kind of a refund or pay less taxes in the future. So that's the difference, okay? Finally, we've got our net profit margin, which is just finally our net earnings at the bottom against net sales. And so what this tells us is for 2016, that 4.4 cents out of every dollar of net sales ended up in net earnings. And out of our net earnings, we would pay our dividends. And so we would have our target in terms of what it is the analysts expected, what we had said we were going to achieve, and then we could determine whether we could pay dividends. Now, in addition to looking at just the fact that we earned a profit for the year and that we met our goals and objectives and we're going to go ahead and pay a dividend, we need to make sure we have sufficient cash on hand to go ahead and pay that dividend. Otherwise, we can't pay the dividend. So you can have earnings and no cash. You can have cash and no earnings. All right, those situations can come up. And so, but each company will have some kind of a dividend policy in place to say when they will and when they won't pay dividends. Then there's one final phase that it oftentimes confuses students. So you go through and you calculate your net income on your income statement, but there's more that drops below that. Okay, and there's something called comprehensive income. And again, what this is it takes into account other things that did not impact the income statement per se, but do kind of affect the earnings of a company. And it's other things that involve transactions with shareholders. And so when we come in and we look at this, we're going to take a look at certain things here. These are other comprehensive income or loss items, and these are reported net of their tax effect, okay? So we have change in unrealized net gain on investments, change in unrealized net gain on derivative instruments, change in defined benefit plan liability, and change in cumulative translation adjustments. So on the investments, these are non-shareholder transactions. So the net gain on investments, or maybe the net loss on investments, okay, the net gain on investments is we've taken our excess cash and we bought investments. And so what happened to them over time? Did they increase in value or decrease in value? Well, since we didn't sell them, we didn't actually get any cash for it. But if they increased in value, say they went from 20 to 29, okay, they show that as an unrealized gain of 9. Okay, and they actually record that as other comprehensive income. Same thing, we have an unrealized gain on derivative investments. Derivative investments are a form of investment that is a calculation. It's based on changes in certain things in the marketplace. It might be based on the changes in the value of something. So it's like you're almost hedging, you're almost betting on whether something is going to go up or go down. That's another type of investment. And then your defined benefit plan liability, whether that's increasing or decreasing, that difference can be booked in other comprehensive income or loss. And then translation adjustments, if you're a company that does international business, it means you're going to be doing a transaction, conducting business in foreign currencies. And so when you're dealing in foreign currencies, it's the change in the exchange rates between US dollar and those other currencies. Sometimes you make out well, sometimes you don't make out so well. And so they capture that and they record it as cumulative translation adjustments. So again, that has to do with the exchange rate differences that occurred during the course of the year between the US dollar and foreign currencies. And all that's added together or netted together to come up with other comprehensive income or loss, net of its tax effect, to calculate something called comprehensive income. So comprehensive income includes net income, but it also includes all of these other things that occurred during the year. So that's important to note. The last item I'll address here is going to be the statement of stockholders' equity. This is a reconciliation statement, essentially. So we look at the one for Sage Inc. from the book. And again, what we have is we've got a couple of columns, and there's several ways that people present this. But this here, we have the shares in one column, the amount in another column, and then we have a column for retained earnings. And then what we do is we go through and we track the activity over time. So we'd start off with balances at December 31st, 2013. So look at the retained earnings. We started off with $24,260 in retained earnings. At the end of 2013, we had net earnings of $5,896. That's going to increase our retained earnings. And then we had cash dividends paid out. That's going to decrease our retained earnings. Overall, it's a net increase. So the balance has gone up to $28,315, and it keeps going on each year. The same for the common stock and additional paid-in capital. So we start off with 4,340 shares at a total of $5,197. And then we have proceeds from the sale of shares from exercise of stock options, net of the tax benefit. And so we look at it as 5 shares were sold at $115 total. And then we had some stock-based compensation. And so the balance has gone up. Okay, and so has the number of shares. And then you can look at each succeeding year and see what activity has occurred in that each succeeding year. And so this way you can look at and kind of reconcile why retained earnings has changed, why has the stock account changed, and why has the additional paid-in capital account changed. Now here they didn't really separate out common stock and additional paid-in capital. Normally you would see that segregated. Okay, but for simplicity's reasons, I guess they didn't do it here. All right, so we're at just over 30, or almost at 35 minutes here. So you need to read the chapter, you need to study the slides, you need to answer questions at the end of the chapter, and you need to email me with any questions that you have about this chapter, about any of the information that's in it. If there's some specific problem from the end of the book you want me to work out for you guys and demonstrate to you, I'm certainly willing to do that. You can go ahead and email me. I did that for chapter 2 as kind of an example to show you how some of the things work. I didn't plan on doing that for every chapter. I figured I would show you what's possible, and then you guys can let me know what it is you would like to see to understand better. So go ahead and feel free to email me with any questions you have about any of the problems in the back of the chapter. I'll be setting up also brief videos or half-an-hour videos for chapters 4 and 5. And also, I'm hoping to talk about the investment assignment. All right, so I'm going to sign off for now. Thanks for paying attention. I hope you guys are getting something out of the class. It's always really hard when you're dealing with an online class. But I do hope that this is working out for everybody.